Hello, everybody. I'm Michael Smith. Welcome to the Lowdown. And joining me today is my special guest, Kevin Lenox. Kevin, welcome to the show. And I thought a good topic today would be, bottom line is, will artificial intelligence or AI's growth short circuit the Fed's interest rate target or interest rate plans? And I thought, Kevin, you know what, you'd be the perfect guy to come in here and talk about that. Now, we do, right now, the last time I think you were on here, the soft landing, right? So that's right. Kind of the idea is that are we going to have a hard recession or we're going to have a soft landing? And I think for the first time in probably my existence in this career, I could probably say, a soft landing doesn't look like it's out of the reach. Typically the Fed's had a hard time hitting the side of a barn with things, but there may be some idea that they could probably get us there, or maybe more of a glide path. I thought you could probably break that down because I think it's kind of split out to basically those that feel like, as far as this, the soft landing, what's going to be the cause of that, right? And so maybe kind of fill us in on what are the underlying components of what might drive that.
Sure. So the central thesis around a soft landing is that we'll have solid growth, not very fast growth, stagnation, just a slow, steady pace of growth, which we've had.
Sure.
Without a rise in the unemployment rate.
Okay.
And we've had that
so far,
as well. We've also had corporate earnings surprise to the upside in the first quarter. So that's good for the labor market in that corporate earnings for Q1 came in 6% year over year versus expectations at the beginning of the quarter of only 3%. Most of the outperformance was driven by large companies. The Mag 7 I mentioned last time had an expectation of 32% growth. They came in now about 48%.
Oh, just 48, huh?
Sales growth of 14%.
Yeah.
And margins increased 0.5% to, call it 22.5%.
Nice.
So you think of law of large numbers. As companies get so big, they can't grow at those types of rates.
Yeah.
But we see continued performance and EPS revisions to the upside for the large companies that are largely self-funded, strong balance sheets, and also have pricing power. And by the way, they can also do buybacks of their own stocks. So that area of the market, we've talked about it for a long time, but continues to outperform, and I think for good fundamental reasons.
So we're kind of in this camp now of, potential seeing disinflation. I'll let you kind of, give a description of what that is for those that don't know. And then, or is it the higher for longer, right? I feel like those are the two splits and camps that we're in. If you don't mind, maybe kind of break down maybe the underlying thesis of each one of those.
So a lot of people have been looking at the components of CPI. Shelter is a large segment of that, particularly core CPI.
Okay.
And the Fed has even talked about it. That should be coming down. Rents, near-term, current rents have been coming down. And there's frustration at how sticky that has been.
How do they see shelter? How do they define shelter in this component, though? I think that's important.
So, there's several different metrics. The ones people are really focusing on are rents.
Okay.
Now, the official data is skewed to existing rents, which, as they've come up for renewal, then there have been much sharper year-over-year increases. That's where the data is. But current rents are seeing a much lower level of increase. So the feeling is by the end of the year, the shelter component of CPI will come down pretty dramatically, giving the Fed room to begin cutting rates.
Okay.
And then they've been cherry picking other areas like transportation services, which is car insurance, hospital services, and say, well, if you exclude those, and then like if you exclude food and
just like
energy,
statistics.
if you exclude everything volatile, then really maybe it's not that bad. But the Fed really does want to cut rates.
So in statistics, my teacher said, what do you want to see? You could take this out and take that out to make whatever story you want. So I think that the important part is understanding what is the Fed, what is guiding and driving the Fed's decision making, right? So if we're going to be, if we're a business right now, we're trying to figure out what certainty or what is the forecast in terms of rates, right? Is it going to continue to be an increased cost for me to go borrow and run my business? Or is that going to come down? Because that's going to change the demand side of that equation. So you said rents. I mean, if correct me if I'm wrong, but that makes up about 30% of that index, right? The CPI index, right? Is that kind of what they're looking at? Is about 30%. And so what you're saying is this thing is a long lagging index, and so it's lagging the Fed's decision making process, correct?
Yeah, and the Fed keeps saying, data dependent, but you're right. You can, if you have a thesis, whether it's inflation or disinflation, which doesn't mean prices going down, it just means prices going up at a slower pace. That's really what they're focused on.
Okay.
But if you have a view, you can find the data to support that
you
view. Now, we'll say also we're going to talk about AI in a little bit.
Well, I was just going to say, let's talk about that because, in general, you mentioned, AI, is that going to, we talked about, is that going to derail the Fed's plans? Well, artificial intelligence, I mean, typically the thesis behind it should be driving costs down in a lot of different areas, right? But I think one thing we're going to find out, and I want you to jump into this, is AI driving down all costs, or is there some costs that are being driven higher? Maybe kind of jump into that one for us.
So all eyes right now are on commodity prices,
okay,
which the Bloomberg broader commodity price index is on the edge of breaking out of a 12-month range to the upside.
Mm-hmm.
And I think there was a study that electricity demand over the next 5 years has increased by 2.5 times since the previous forecast just a year ago. And so the grid will have to be revamped.
Yeah.
There'll be a big need for commodities to build out this grid to support this increase in demand. And one of the other things we're looking at is, what about the search engines?
Yeah.
And how much they use. So if
Yes.
Google just changes their basic search engine to AI, it'll consume 10 times more energy. So what's going to fuel all that? And that, I think, puts a higher level of inflation in place on top of the multipolarity, in global supply chains not being nearly as efficient, plus this global starvation of capex for energy.
Yeah.
Really for the past 8 years. It's starting to catch up now, but there's a structural deficit, I believe, there. So those are challenges for the Fed and the supporting points for the higher for longer camp.
Well, and also what markets don't like about that, I mean, think about it this, artificial intelligence is a new component and dynamic to enter the equation, right? If you looked at energy and what was going to drive energy costs in the past, it was, where's demographics? Where's usage, right? I mean, it was not simple, but it was a lot simpler. You had fewer metrics, employment versus unemployment data in those areas. But now you're telling me it could be someone in any country, anywhere, and if they're using AI, I mean, that is increasing that energy usage. And I don't quite feel that anyone has a good grasp on what that's going to look like yet. So that leaves things really for uncertainty, which this is going to kind of get me into kind of maybe, wrapping up things. But it's like, where are the opportunities, right? How do you position yourself for something like this?
It's tough. I could build a good case on both sides.
Yeah.
And just go to the power of AI. I don't know if you've noticed it, but when I do searches for things, I find that afterwards I get a lot more data that supports that exact same view.
Yes, and it's categorized a lot easier for me to read. It's actually almost being personalized to me. That's scary. We'll talk about that a whole other day.
Which flies in the face then of behavioral finance mistakes that people make. It's like, oh yeah, I'm right. And as Mark Twain once said, or at least he's alleged to have said, it's not what you don't know that kills you. It's what you know for sure that just ain't right.
Yep.
So I think we have to be much more vigilant now in how we look at things. But from an asset allocation standpoint and just where we go, the best thing to do is what we've been talking about for a long time here. I still think the U.S. is best positioned versus other countries around the world. And those large self-funding businesses with a strong balance sheets that can do the buybacks, and have pricing power.
Yeah.
Those companies I still think will continue to lead. Now we've got a sell-off going on today. And the small cap Russell 2000, which are the more vulnerable type companies, down I think twice the percentage rate that the S&P. So I think we're going to have more and more of this. So the valuations aren't cheap.
True.
But I think the market will only give PE expansion to those type of companies that can deliver earnings and positive EPS revisions on top of that. So more selective market as it's been. And then on the shorter side, probably versus benchmark duration.
So if I
on the
was
bond
to
side.
translate this a little bit of English, right, it would be buying companies that could basically, their product, their service, they can function on their own and their own profitability. I think many people don't realize how much this stimulus from the government and all hands have really driven a lot of business and multiple expansion that's not truly there to stand on their own. So finding those companies that can truly stand on their own is key, and we call those value or quality companies.
Yeah, maybe one word is the company an oligopoly.
There, okay, well, there you go.
That they fit the bill.
Well, and they'll try to break them up, sure enough.
There are, I believe, 5 bills out there
Yeah.
to try to break up big tech.
Yeah, oh, there is.
We'll see if it goes.
We'll see if it happens. Well, Kevin, as always, very insightful. Again, we'll still figure out where we are next time we speak on this soft landing, hard landing. But in the meantime, it sounds like follow this advice. It's well said and well put. And thanks for joining.
Happy to be here.